Welcome to the Explainer. Now, if you're a degree or ACCA student currently staring down the barrel of an audit and assurance exam, you already know that the leap from theoretical textbook rules to actual, on-the-ground fieldwork can feel, well, massive. But today, we're taking that exact leap. We're going to distill Chapter 7 right down into a focused, highly practical journey. We'll be looking at the precise rules governing audit evidence, and honestly, more importantly, how auditors actually apply those rules in the real world. So let's dive into the ultimate detective's question. When a company hands over its financial statements, they're effectively giving you a massive list of claims. They're claiming, we have this much cash, we owe this much debt, and we made this much profit. But how do auditors actually prove those numbers are real? Because as you already know, in the world of auditing, just taking management's word for it, that doesn't cut it. We need rigorous, undeniable proof. Here's our mental roadmap for today. 1. The objective of evidence. 2. Sufficiency and appropriateness. 3. The reliability hierarchy. 4. Assertions, or testing the claims. 5. The auditor's toolkit. And 6. Documenting the audit trail. Okay, Section 1. The objective of evidence. This is the foundational rule. What's really interesting about the specific language used in ISA 500 is how it frames our entire job. It literally states the auditor's objective is to design and perform audit procedures in such a way to enable the auditor to obtain sufficient, appropriate audit evidence to be able to draw reasonable conclusions on which to base the auditor's opinion. Notice the two absolutely crucial words there, sufficient and appropriate. Obtaining evidence that hits both of these marks is the entire core mission of your fieldwork. Moving right into Section 2, Sufficiency and Appropriateness, it's all about balancing the scales. Let's break this down. Sufficiency is all about quantity, right? Do you have enough evidence? Appropriateness, on the other hand, is all about quality. Is this evidence actually relevant and reliable? The key takeaway here is this. Broadly speaking, if you have highly reliable evidence, you might actually need less of it. But, and this is a big but, if the evidence is completely unreliable, it's never going to be appropriate no matter how much of it you gather. Think about it. Stacks of fabricated documents are still just fabricated documents. So when you're out there actively planning your testing, how do you decide how much is enough? Well, it boils down to professional judgment, heavily influenced by a few key factors. If the risk of material misstatement is high, or if the item is highly material to the financials, you're definitely going to need more evidence. If the client's internal control systems are a mess, you can't rely on them, so again, you need more substantive evidence. Conversely, if you have deep, solid knowledge of the business and the source of your information is incredibly reliable, you can safely scale back the quantity. Which brings us to Section 3, the reliability hierarchy. Because, spoiler alert, not all evidence is created equal. Let's look at this framework of trust. As an auditor, you should always be striving for evidence from that more reliable column. External, independent sources are infinitely better than internal, client-generated ones, mostly because of the inherent risk of management bias. Evidence you obtain directly, say physically inspecting an asset yourself, totally beats evidence obtained indirectly. Written documentary evidence will always trump oral statements, which, let's face it, can be easily withdrawn later. And finally, original documents are way harder to tamper with than copies or electronic scans. So an independent external written confirmation, that is your absolute gold standard. Let's apply this to a real-world scenario straight from your text. Picture this. You're auditing receivables. The finance director looks you dead in the eye and tells you that a struggling customer is definitely going to pay their outstanding debt, so there's absolutely no need to write it off. So, do you believe them? The answer, driven completely by professional skepticism, is a hard no. Client-generated oral evidence is literally the least reliable form of evidence on our hierarchy. The finance director has an inherent bias here, right? Writing off that debt directly reduces their reported profit. So to exercise professional skepticism, you can't just accept their word. You have to actively seek alternative corroborative evidence. You'd want to go look for post-year-end bank statements to see if the cash actually arrived, or maybe review independent correspondence between the client and that customer. You never just take management's convenient word for it. Section 4. Testing assertions. This is where we talk about the relevance of your evidence. Financial statements are essentially divided into two distinct buckets: transactions and events that happen during the year, like sales, and account balances sitting there at the year-end, like inventory. And you have to test different assertions for each. For a transaction, you're testing occurrence. Did this sale actually happen? But for year-end balance, you're testing existence. Does this inventory physically exist in the warehouse today? The evidence you gather must perfectly align with the specific assertion you're targeting. All right, Section 5, the Auditor's Toolkit. Let's talk about the actual procedures you'll use out in the field. First up is external confirmation. As we just learned from our reliability hierarchy, getting a direct written response from a third party sent straight to the auditor, that is a top-tier procedure. So here's how you actually do the job in practice. You'd send a receivable circularization letter directly to a sample of your client's customers, asking them to confirm exactly what they owe. This brilliantly proves the existence assertion. The customer is literally agreeing the invoice is real. But be really careful here. It does not reliably prove the valuation assertion. A customer confirming a balance doesn't guarantee they actually have the cash in the bank to settle it. You always have to match the tool to the correct assertion. Next in the toolkit, analytical procedures. This involves evaluating financial info by looking at plausible relationships among both financial and non-financial data. It's an incredibly efficient way to audit an entire account balance for reasonableness all at once. Let's look at exactly how auditors execute this using a proof and total technique. Say you're auditing payroll. Instead of manually checking thousands of individual payslips, which would take forever, you take last year's total payroll cost. You inflate that number by any known company-wide pay rises and adjust it for the net change in staff numbers over the year. Boom. You've just built an independent, auditor-generated expectation. You then compare your expectation to the client's actual current figure. If they're really close, you've just gathered highly efficient evidence over the entire payroll balance. Moving right along, we have inspection and observation. This is the fundamental groundwork of auditing. It's getting your hands dirty with the documents and physically watching the client staff in action. In practice, inspecting a property title deed directly provides evidence of the rights and obligations assertion. Attending a year-end physical inventory count and observing the client's staff gives you fantastic evidence of the existence and condition of that stock. But there is a massive psychological limitation to observation that you absolutely need to remember for your exams. It only proves the control worked at the exact time you were watching. Because, let's be honest, people tend to follow the rules perfectly when the auditor's standing right over their shoulder with a clipboard. Finally, Section 6, documenting the audit trail. The golden rule here is if it isn't documented, it didn't happen. ISA 230 sets the standard here. Your working papers must be so impeccably clear that an experienced auditor with absolutely no previous connection to the specific audit could pick up your file and immediately understand exactly what you did, when you did it, what results you got, and the significant professional judgments you made to reach your conclusions. You're basically leaving a trail of breadcrumbs that proves beyond a doubt that your opinion is backed by hard facts. Which leads us to a final, slightly provocative thought to leave you with today. We've talked all about frameworks, hierarchies, and toolkits, but remember, an auditor provides reasonable assurance, not an absolute guarantee. So, if assessing the sufficiency and appropriateness of audit evidence ultimately relies on your subjective, professional judgment rather than absolute mathematical proof, where do the true limits of an auditor's responsibility actually lie? It's the heavyweight of the profession, for sure, and something you're going to have to grapple with every single day in the field. Thanks so much for joining me on this explainer, and best of luck applying these standards.